Good morning, everyone. Welcome to the TradeStation Masterclass. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. Always a pleasure to be here, and also very glad to see everyone connected. Thank you for taking time out of your schedules to be here and talk about the TradeStation technology and the potential you can have with the TradeStation software. Today, it's all about open interest or futures open interest and COT data. COT data, usually referred to as commitments of traders data, can be utilized to analyze futures momentum and direction. So let's go ahead and take a look at the studies that are part of the TradeStation platform around this concept. A few disclosures before we get started. Keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, and past historical performance is no guarantee of future results. We are going to take a look at strategy performance report and a little bit of strategies, and everyone needs to be aware that what we see in the strategy, of course, or the strategy performance report is not going to be an indication of future results, and I want to stress that in this class. For additional information on our disclosures, go to www.tradestation.com/important-information, as you can see right here on this slide. Okay, let's talk a little bit about COT data, what it means, and how you can utilize it on your TradeStation analysis. Commitments of traders. It's a weekly report from the CFTC, which is the Commodity Futures Trading Commission, on everything that is traded in the futures market. It includes all open interest across all contract months for a commodity. If you're a futures trader, you know that every commodity contract has its specific month and expiration year. So in terms of the commitments of traders, it is a combination of all the contracts that exist for a particular commodity. So for example, if you're looking at silver, that would be, any month contract that exists for silver. Right now, from the top of my head, I don't know, what months are there as expirations, but you're going to have the March, the December, the September, and all together, stitched together and added in this report. It reports on three trader categories, which are commercial traders, large speculators, and small retail speculators. We're going to talk a little bit more detail as to what each one of these groups represent, but there are going to be three main categories that are very specific on this report. And the data is supplied by all reporting firms. That includes TradeStation, futures commission merchants, clearing members, foreign brokers, and exchanges. So we all have to report this data to the CFTC, and they compile all the data for their report. The information in the report is compiled each Tuesday. It is processed on Wednesday before being released on Friday that same week. So as you can tell, it's a weekly report released on every Friday for that week's commitment of traders' data. The report provides transparency and understanding of the market dynamics of futures trading. We're going to take a look at why and the indicators that are part of TradeStation that allow you to read this data. Okay, let's go ahead and who are the players? So this is the part where we talk about the three different categories in which this report is presented. The first group is the commercial. These are traders that trade on behalf of a business or institution, typically hedging a commodity their business owns or uses to create products. For example, Kellogg's, of course, is going to produce cereal. And in the cereal production, if that's the right terminology, they're going to want to use corn. So commercials or these institutions or these companies are going to be interested in trading futures contracts to guarantee some prices when they sell the cornflakes or when they have to buy the corn to produce the cornflakes. That's what the commercial category. They're very interested in the commodity that they're trading in. The next group is the non-commercials. These are the traders that are considered large speculators, institutional investors, hedge funds, who have no business interest related to the commodity. So they don't care about taking delivery of corn because they're not going to do anything with the commodity itself, but they are there for the ride. So they want to speculate on the prices of the commodity. However, these are not just normal speculators like the individual retail traders. These are speculators that are big traders, and they have to meet a trading threshold in order for them to report this to the CFTC. So even though these are also speculators, we're going to call these institutional traders, hedge funds, where a lot of people call this category smart money or smart traders because they have usually a good handle on where the market is headed. But the fact that they are trading beyond a threshold, that makes them part of this group because they have to report how many contracts they're trading. On the other end, this is the third group. These are the speculators, and these are the ones who hold or control a position in futures below the reporting level, but are only there to profit from the market moves. So non-commercials and speculators are very similar in the sense that they're both trying to benefit from the market movements, but the only difference is that non-commercials are trading in bulk quantities beyond a threshold that obligates them to make a reporting to the CFTC. So those are the three main categories for COT data, commitments of traders. And it's called a commitment because it does take a commitment when you put a position into the futures market. So what are they committed to? Are they committed to being long futures? Are they committed to being short? That's some of the ideas that we're going to take a look at once we go over to the TradeStation platform to look at these studies. TradeStation COT data. So TradeStation collects and processes the COT data from the CFTC on Friday. So as soon as it releases the report, TradeStation is going to process that data and is going to publish it on the TradeStation Data Network. But it's going to backdate the data to Wednesday. Why Wednesday? Because the report is compiled on the evening of the Tuesday. So this is data that is reported up until Tuesday, right? The CFTC processes the data on Wednesday, publishes the data on Friday, and what TradeStation does, it gets the data on that same Friday as soon as we get it from the CFTC, and we're going to put it on the network, but backdate it to Wednesday because the data is going to be from the day before, from the Tuesday when it's finally tallied. Does that make sense? So there are three indicators that are built into TradeStation that display this COT data. The first one is COT net position. The next one is COT total position. And then we have the COT total position percentage. Let's take a look at all three and understand what they do. The indicators are best used on weekly intervals, and it makes sense because the data only changes once a week. Every Friday, the data is processed and backdated for Wednesday. So every Friday, you'll see a new data point collected for this indicator. And the COT indicators that come with TradeStation allow you to display the data with or without options contracts included. It's a setting in the input. When you first put it on the chart, is without the options contract, but if you want to add that additional layer on the COT data, you can just turn that on as part of the inputs of the indicator. It's a good question, Rich. What time on Fridays does COT generally come out? It's usually towards the end of the day. So as the day is trading in real time, you'll see the bar updating, but it's not until the close of that bar, the daily bar, that TradeStation actually processes the data and put it on the network. Yeah, I've seen that. I'm not sure if it's changed, but that is my understanding that it'll wait until the close of that Friday to report the data onto the TradeStation Data Network. All right, so how to trade using COT data? Well, it can be used as directional guidance or filter to time entries and exits. Today, we're going to take a look at a strategy that uses COT data as a confirming indicator when you're placing long or short trades. It also helps identify the trend by knowing what big traders, which are the non-commercials, are doing. So we're going to consider the non-commercials to be the group that knows where or have a better understanding of where the market may be headed. Remember that the commercials are the ones that are interested in the commodity, and a lot of times their position is going to be opposite of what the market is expected to do. For example, bullish traders are long or increasing their long position. A negative commercial net position is considered bullish, and it makes sense, because if a commercial, a trader that is interested in receiving delivery of the commodity, a lot of times they're going to sell contracts because they think the price is going to go up. So it's a bullish signal when the commercials are bear. When the commercials are negative, meaning that they have more short contracts than they have long, is because they think the prices are going to go up and they're going to try to protect their positions. The same thing happens when they're bearish. Traders, usually when they're bearish, they're short or increasing their short position. But on the commercial side, they're going to be positive. They're going to be buying contracts because they think the price, or selling contract or buying contracts because they think the price is may go down. So a positive commercial net position is considered bearish. Also, the slope of the net position may help identify weaknesses or strength in a trend. So a lot of times it's not really about the value that gets reported, is the direction where that line is headed. So it's very interesting how we can look at the historical values of COT and see if the values are increasing or decreasing. Are traders becoming more bullish or less bullish, or more bearish or less bearish? So whichever indication these lines can give you, they can be used as trading signals or even as ways of confirming your trades. As I said earlier, we're going to take a look at a strategy that uses COT data in the sense of confirming a trade, and it's going to be a very interesting exercise. The strategy, by the way, is part of that zip folder that I just shared here in the chat. Let me go ahead and share it with you one more time so you all have access to it, and we'll take a look at that strategy together, okay? Perfect. Let me switch over to my TradeStation platform to take a look at some of these indicators. So let me go here to TradeStation. All right, on my screen, I'm looking at a daily chart of corn. And let's just go ahead and go analyze one study at a time. I'm going to click on Add Study. Okay, let me scroll down to the C's where COT data is. So these indicators will start with the initial COT for COT, commitments of traders. And this is the net position. I'm just going to click OK and take a look at what the indicator is telling me. Okay. All right. So this is on a daily chart. The first thing that you're going to notice is that the indicator has that staircase type of look, because as we said earlier, the value doesn't change every single day. I'm looking at a daily chart, so I'm going to expect the values to be the same for a full week, or at least until Wednesdays. I think on Wednesdays is when we backdate the data. So I'm gonna expect a shift on Wednesdays. If I look at the data today, and you can tell, today is Tuesday. On Tuesday, we don't have a value for COT, just because, again, we're waiting for the closing to process all the values. Today, it's not the day where the COT value, it will change, but you notice that on the day before, this is March 10th, these numbers, at least let's focus on the green line for now. The green line, you can see that represents the non-commercial. How do I know that it's a non-commercial? Because I can see it on the data tips. If you look at the bottom of your data tips, you're going to see that the non-commercial has the green numbers. So the number at the moment is 335,438 to be specific. And if I go back here to the prior bar, this is Friday, you can see that Friday has the same number. Thursday has the same number, 335,438. And Wednesday, this is Wednesday. Wednesday, let me do that again. So today's Monday, today's Tuesday. The day before Monday, this is Friday. This is Thursday, Tuesday, Monday, Friday, Thursday, Wednesday. And then on Tuesday, this is Tuesday, which is March 4th. You can see that Tuesday, we had a different number for the non-commercial, which is 441,161. So it wasn't until the close of the following day, this is Wednesday, where we get the real number. The real number for this week is 335, 438. But keep in mind that TradeStation did not know about this number until the Friday. Friday was the 7th. So on the 7th, we published the data and backdated it as if it was published on the Wednesday. Does that make sense? But notice how the value will not change until the new Wednesday comes around. So tomorrow, after the close of the market, we should see the new number come through and see if there's an increase or decrease on this green line, which are the non-commercials. I wanted to explain, some of the intricacies of COT data and why it shows the same value day after day on a daily chart. So if I wanted to change the time frame to a weekly chart so I can see how it changes from bar to bar, that's something that I can do. So changing it to weekly, then we have a more a line that updates on every single bar, and you can see that at the bottom how the lines interact with each other. Okay, so at any point of your analysis, if you want to understand or identify which line is which, click on the background of the chart, get access to the data tips window, and at the bottom, you can see the labels and the color of the line. So the commercials are the blues, the non-commercials are the green, and the speculators are the red. We already identified the groups. The commercials are the ones that are interested in the commodity in the sense that they want to take delivery, they want to, use the corn, they want to use the silver, whatever the commodity is, and they're hedging against market movements. The non-commercials are speculators, but speculators in a large quantity. So institutional traders, hedge funds, big corporations that are trading beyond a threshold that requires them to report their trading. And then the red line are the retail trader, the speculator that doesn't have to report their sizes because they don't go beyond that threshold. And we can see what this is the name of this indicator is net position. I should have started with total position, but this is net position. Let me explain total first so that it makes sense once we go over to this one. So let me go to add study. I added net position, but the one that I wanted to add first was total position. Let's go to total position. They're very similar to each other in the sense that they'll plot 3 lines with the same 3 colors. But total position is right here at the bottom. Let me go ahead and remove this one for a moment. So this is my total position. You can see how the commercials are at the top and the non-commercials are second. The commercials, as you can see, are the ones that trade the most contracts. By the way, the number that you see here on the far right is open interest. So these are open contracts, and you can see that the commercials have 1.7 million open contracts in the futures market. Whereas if you look at the non-commercials, we have 650,000, and the small speculators, the retail speculators, have about 312,000 open contracts. What this is doing, by the way, so you can understand the values here, this is adding all the short positions plus the long positions and adding them together without netting them. So these are just open interest, open long, open short, adding them together. So there's a total for the commercials in this particular of 1.7 million contracts open. It doesn't make a differentiation between short and long. That's why I wanted to start here, because this is just adding open contracts. When you look at the other study that we added first, which is the net, let me show you that, COT net position, okay? You can see that the net position, which fell right here in the middle, is giving you net. So it's adding all the shorts versus the long. So when you see that a line, in this case, the non-commercials are a positive 335,000 is because they have that many more long contracts over the shorts. So it's just going to add all the longs and the shorts. In this case, it'll respect the positives and the negative and net them out. Their total is 650. So out of those 650 contracts that are open, they have 335 more contracts than they have the short, which is pretty interesting. So you have these whole group or category of traders that are considered non-commercials but are trading in bulks, and the majority of those traders are net long. There is a small decline in their long position. So even though they're still positive long, you can see that there's a small decline on the past couple of weeks. Maybe it's got to do with the fact that markets are kind of trending down, and maybe this group is getting rid of some of their long trades. They could be two things. They could either be getting rid of some of their long positions, or they could be increasing their short positions. So it can be interpreted both ways, right? But what we see is a decline on their net position, going from long to less long. I mean, they're still positive. They still have more long positions than they do short, but they are reducing their positions. It's very interesting how we can interpret their movement and their inclination on these markets. When you have a negative number on these on this indicator, the net position indicator, it's because that group has more short contracts than they do long. And in that category, we have the retail traders. They have 62,000 contracts more than they do the longs. And the commercials, they're also very heavily shorted at 272 contracts over their long position. So it's very interesting how we can see their net position play out. Notice how different these numbers are, because if you look at the commercials, which is the blue line, that's the group that has the most contracts or the most open positions with a 1.7 million. But if you look at their net, they only have 272,000 contracts short over the total long. Interesting concept. Now let's take a look at the other study, because the other study is going to provide you with the similar values, but translated into a percentage. This is caught total position percent. All right, where did it fall? So we have net position right here at the top, total position in the middle, and then position percentage right here at the bottom. And if we look at the percentages here on the right-hand side, let's take a look at the blue line. We said the blue line were the commercials, right? 64.7%. What does that mean? Well, it means that out of all the open contracts, and how do you get open contracts? Well, you have to add the commercials total, the non-commercials total, and the speculators total. You add those three together, and then look at the size of the commercials. So what this total position percent is telling you is that commercials are holding 64% of all the open contracts, the open interest on futures contracts. Pretty interesting. Whereas, the non-commercials are at 23.9 or 24%. The retail at 11%. Does tell you the size of the market that they're holding. But a lot of times, as I said at the beginning, if you're interested in following the non-commercials, which are considered smart money, that could be a strategy. If you want to follow the commercials and take a contrarian approach to their trading, that is also a trading strategy. It all depends, on your analysis and what you want to do with the data. Let's take a look at some custom studies that are based on this same idea, but give you a different graphical representation. I'm going to assume that the non-commercials are the group that it's a little bit more familiarized with the market, is what some traders call smart money. These are large hedge funds, institutions that are trading beyond a reportable threshold, and they're required to report their trading to the CFTC. And the two indicators that we have there in that zip folder are based on those non-commercials. Let me go in and show you those indicators. I'm going to remove total position and total position percent. I'm just going to leave the net position for now. I'm going to go to studies and click on add studies. The studies that I provided right there with the zip folder start with at MC COT right here. So I want to take a look at non-commercial net change and see what it looks like. All right. In fact, let's take a look at both. There's two studies in there, because both are going to be very similar in what they're reporting. All right. So this is as you can see, the line that you see right here at the bottom, this is the non-commercial net position percent, which is very similar in, if you take a look at the blue line up here, I'm sorry, not the blue line, but the green line, it's very similar to the green line because it's calculating that net position, not as a number, but as a percentage. So that's the only difference between these two lines, that one is showing you percentage and the other one is showing you just a net total position. But you can see the movements are exactly the same, but you can see how and when this group of traders is flipping from a net negative to a net positive. They're switching from a bearish to a bullish position. And when that bullish position is losing steam. So you can see that in the past couple of weeks or few weeks, you can see how that momentum that this line was displaying is actually losing its strength. This indicator that looks like a histogram is also based on momentum and how it's changing. But what it does is it calculates the difference between one bar and the next and see the increase or decrease of that momentum. So if you take a look at this big spike at the very end, which has a, what's the value here? Net change is 16%. What that means is that from the day before, from this day before, we are looking at the non-commercial with a net position of 441. It dropped to 335. That was a 16% from one bar to the next. And that's what's represented over here. So whenever you see a green bar, it's because from the bar before, it's been an increase of a certain percentage. The interesting thing about this histogram indicator is that we're monitoring bar by bar how the non-commercials are increasing or decreasing and by how much. And we can establish some thresholds of our own to see if that is something that is significant or not. If you take a look at the two dotted lines that are in yellow, those are customizable thresholds that as a default are set to 5 and -5. So the only histogram bars that are color-coded are the ones that are above or below that threshold. You can see that the green ones are above that 5%, and the ones that are red are because they're below that -5%. So it gives you an indication of the extremes. And we can use indicators like this to look at strategies and maybe use them as a confirmation to what we want to do based on a basic concept. Let me show you what I mean by that. I'm going to open up a workspace and talk you through some of the items or some of the things that I've done. So I'm going to go here to this workspace, which has two charts. So you can see the two charts on the right-hand side, and it has a radar screen on the left. You can see that on the far right, we have that study that we just talked about, the one that has the thresholds and the one that keeps track of how the non-commercials are moving up or moving down bar by bar. Inside of my radar screen, I'm not sure if you're aware of these symbology, but these are custom futures. Why is it that I have custom futures in here? It's because regular continuous future symbols are back adjusted. So let me show you what I mean by that. I'm going to do that. Let me go here to this workspace that I was in. Okay, this is corn on a weekly chart, let's see on a weekly chart. And this is just a regular continuous symbol. That I said that this is back adjusted, right? So it's going to apply a factor to historical data, meaning that, and you can understand that a continuous contract is just taking all those different expiration month futures and stitching them together and then showing you a continuation of prices. But since these products are trading at the same time, many times prices fluctuate and one contract may be trading higher or lower than previous contracts. That difference in price is what is back adjusted. So if there's a big difference in price, we'll apply a factor so that it's a continuation of prices. So if the prior contract was trading, 2 or 3 points lower, we'll add 2 or 3 points to that historical data so that it matches the continuation of the current month. Hopefully that makes sense. But I just want to say that, yes, the data is back adjusted. So in this chart, that it's going back, let's see how far back this is going. This is going back 10 years. So if I check the date on the very first bar here, let's go scroll here to all the way to the left. So this chart begins in March of 2015. 2015 is exactly 10 years ago. And you can see how the price of corn was about, if you look at the closing price right there on the top left corner, it says the close was 402 and 4/8. Let's keep that number in mind, 402. Because if I come here into the data, this is corn, I'm going to go to lookup, but instead of using just the regular futures, I'm going to go to custom futures. The root of the symbol here is C. When I put in the C, it's going to tell me what are the expiration months of that commodity. In this case, corn expires March, May, July, September, and December. I'm going to leave all the expirations checked. The only thing that I'm changing here is the back adjustment method. Instead of using an absolute difference, which is what we saw on the continuous, I'm going to do an unadjusted. Unadjusted means that don't mess with the price, leave the historical contracts the way they are, even if it generates gaps. I'm going to click OK, and then put this on the chart. So the data here is going to be unadjusted, and I want to see what difference does that make in price. If I go back in here and I check, the bar for March of 2015, take a look at the closing price. The closing price is not 402 anymore. It's actually 380. 380 is an exact reflection of what the price was trading back in March of 2015. There's no back adjustment. So that's the reason why when you apply a strategy, let's say, for example, to a continuous symbol, these are things you need to be aware of. I'm not saying that one way is wrong and one way is right, because if you are basing your trading signals on percentage movement, maybe it's okay to use back adjusted price. But if you're looking for specific prices, be aware that when you plot a continuous contract, that the data is going to be back adjusted. All that just to say that on this workspace, I'm using custom futures. These are futures contracts that have not been back adjusted, is using raw data. What this is doing though, and I want to talk a little bit about the strategy before I let you guys go. The chart in the middle is a chart that's, let me just maximize this chart so we can concentrate on it. Okay, so this is a simple strategy based on a moving average. By the way, this strategy that I have here is built into TradeStation, is just the moving average cross SE with the moving average cross LE. So whenever the price activity crosses below the average, it generates a trade. And whenever it crosses above the average, it generates another trade. The strategy flips you back and forth between long and short. You can see you're always in the market, but it's a strategy based on moving averages. If I squeeze the chart here, you can see that every time that there's a crossover on the average, I get an entry. Now this is on a daily time frame. Let's see how far back this is going. So my chart is going back 5 years. If I scroll all the way back, you can see how the strategy is generating all those trades. A lot of times, like over here where my cursor is, you get a lot of noise. The strategy is flipping you back and forth multiple times, day after day, because there's no trend. Remember that the moving average cross strategy is a trending strategy and reacts well when the market's moving up and moving down, moving up and moving down. When the markets are moving sideways, you get a lot of flipping back and forth, and you get those back-to-back trades that are not really good on a trending strategy. But it's okay, because this concept of COT data, we can start introducing it here to confirm what the signal is. Because, the strategy may think that, hey, we generated a long trade, but let's go ahead and take a look at what the non-commercials are doing. And if we see an increase in their position, in their net position, then we're going to take that as a good trade. Let's go ahead and, but before we do that, let's go ahead and take a look at the performance of this strategy. I'm going to go here to data and click on strategy performance report. This is not the symbol that I wanted to look at. Let's go ahead and double click here. Okay, I'm going to change this to corn, which is the first one that we started looking at. Okay, let's go ahead and maximize this chart. All right. We can take a look at the beginning of the chart if you want to. Okay, so at the beginning of the chart, yes, the first trade was a long trade. You can see that it switched to short and then long. And over here, we have trades that are back to back, a little bit noisy, not a real trend. And you see all those trades back to back, we're losing trades. Are we able to make that better by introducing a confirming signal? Maybe. Let's go here and go to data and go to strategy performance report. So this strategy, which is a moving average cross strategy, is almost breaking even at 1.24. You know, it made $57,000, but it lost 46. The net profit is 11,000. There's no cost built into the strategy backtest yet. So this is not including commissions. So I'm sure that once you start including commissions and slippage, this will turn into a losing strategy. But out of the box, it's showing me some net profit. In 10 years, I see 99 trades. Only 22% of the trades are profitable, which is kind of scary. Although in a trending strategy, I'm looking for, you know, somewhere between 30 and 40% of trades to be profitable. This is very low. You know, I only have 22 winning trades and 77 losing trades. So I know it's a strategy that needs work. Let's go ahead and take a look at that filter and show you how it's applied. This is a strategy. Let me go ahead and maximize this. First of all, let's take a look at the conditions of the strategy. I like to look at the easy language for it so you can take a look at the conditions in detail. I'm going to go here to easy language. All right, this is a lot of code. And if you haven't seen, you know, easy language code, it may be a little bit overwhelming. But a lot of these lines, you know, 17 to 25, is just the way that TradeStation easy language gets the CFTC data. This is COT futures, you know, commitments of traders futures data, and it has some symbols and numbers depending on, you know, which type of data you want to read. The non-commercials have a specific code, and that's what we're looking and reading from the data. But once we get the data, we make a calculation. We are comparing the non-commercials net current with the non-commercials net 1 bar ago, and then dividing it by the current non-commercial total. This will give us a percent change. We needed to calculate that to see if that percentage is going up or down. Now, MA bullish, you can see here the condition. This is the buy condition. And MA bullish is defined as close being greater than the moving average. So the closing price is above the average. That is bullish. MA bullish, but it's also looking for the change in the net percent to be greater than the bullish level. What is the bullish level? But the default bullish level is 3. So what it's looking for, in simple terms, is for the change to be 3% the upside. So if you're getting a long signal on the moving average crossover, it's going to look at the non-commercials net position, and it's going to want that net position to have increased 3% from the previous day. Interesting, right? It's an interesting confirming signal. And if it finds that it did, it'll take the trade. But if it didn't, it won't take the trade. Now, we were looking at a specific area at the beginning of the historical period. We went, 10 years ago, or 10 years back on the chart. Let's go back to that same area. All right. It was somewhere here. I know that we had back-to-back trades that are not visible anymore, even though we have a losing trade right here at the beginning and another losing trade, another losing trade. What I see is that we don't get those back-to-back trades when it's flipping back and forth between that moving average. So the filter is filtering something. Now, is it filtering correctly? I don't know. But let's take a look at the strategy performance report. I'm going to go to the data, strategy performance report. Okay. The net profit got better. We're still, making about 50 grand in 10 years and losing 20 grand. So the profit factor is 2.43. I feel more comfortable with a 2.43 than a 1.20, which we had before. That doubled our profit factor. If we scroll down here, we see a total number of trades are 36. If you guys remember, we had 99 trades, but look at the percent profitability. 41% of the trades are profitable. So I feel a little bit more confident about the way that this strategy is performing. Although, as we said at the beginning of the presentation, this is no guarantee that it'll do exactly the same going forward. But we want to see what effect, a confirming type of indicator has on the way that the strategy is generating long or short trades. Let me go ahead and see other things of this strategy so you can understand what it's doing and you can play around with the strategy as well. So if you guys, let's see. So now we're not looking for, if you think about the strategy, we're not looking for a crossover anymore because it considers the strategy being bullish as long as the price is above that moving average. All the candlesticks that are right here in this section, where my cursor is, all those candlesticks are above the moving average. So they all meet that bullish condition. But what it's waiting for is for this indicator to be above the threshold of 3. As soon as we get a threshold of 3, which we got here, we can see how the strategy is getting ready to put in that buy signal. And that's what we have, a buy signal right here. There is a selling transaction that happened up here because as long as the non-commercials maintain those or that increase in day to day, is not until it drops by a threshold, in this case, this example is -3, that it generates a selling transaction. So notice that it changed the nature of the strategy a little bit. Now it's not only focused on the crossovers, it's focused on what the non-commercials are doing, whether it's moving up or moving down, and it's taking trading decisions based on that. So it did change a little bit in terms of what the strategy was looking for. But commitments of traders data does provide you an additional layer of analysis that you can add not only to indicators, but also to strategies and see where those groups are headed. Are they moving to the positive side? Are they moving to the negative side? Are you going to look at the commercials, which are the parties interested in the commodity itself, or are you going to be looking at the non-commercials? As I said before, the custom studies that you're getting on this zip folder are all based on non-commercial movement. But take a look at the strategy, take a look at the study, try to understand its mechanics, because it's really interesting that you can use this COT data as a way to confirm trades. That's my class for today, guys. I hope that you enjoyed the information. Let me share with everyone here my email in case you didn't get the study or you're having difficulties. Just make sure that you reach out to me via email, education@tradestation.com. Thank you, Rich. Thank you, everyone, for being here. I hope to see you in a future class. Check the event calendar. We have all sorts of topics coming up, so make sure you join us, okay? Have a wonderful day. Great seeing you. Bye-bye.